Most seniors have not heard about this new IRS rule yet, but it could quietly affect your money, your tax filings, and even the benefits you depend on. If you receive Social Security, SSI, SSDI, VA benefits, pension income, retirement distributions, or any form of federal support, this update is something you cannot afford to ignore. The Internal Revenue Service has introduced changes that are already influencing how income is reported, how payments are tracked, and how eligibility for certain financial protections is determined. Many retirees assume that once they stop working, their tax situation becomes simple. In reality, new reporting standards and compliance requirements are making retirement finances more complex than they have been in years. Today, we are going to carefully explain what is happening, why it matters, and how you can protect yourself from making a costly mistake. For decades, seniors followed a familiar routine. Income arrived from Social Security or a pension, a tax form showed up in the mail, and filing season came and went with little stress. But the financial world has changed rapidly. Electronic payments have replaced paper checks for many Americans. Banks now share more data with federal agencies. Retirement accounts are being monitored with greater precision. Even small side income, which many retirees use to keep up with rising living costs, is receiving new attention from tax authorities. The IRS says these changes are designed to improve accuracy and reduce fraud. Officials believe that better reporting helps prevent identity theft, stops improper payments, and ensures that benefits go only to those who qualify. While that may sound reassuring, the transition has created confusion across the country. Tax professionals report that many older Americans are unaware that the rules have shifted, and some are learning about them only after receiving unexpected notices. One of the biggest misunderstandings among retirees is the belief that Social Security benefits are always tax-free. That is not always true. Depending on your total income, a portion of those benefits can become taxable. What makes the new IRS approach important is that income is now being matched and verified more quickly than before. If something does not line up exactly, the system can flag it automatically. Imagine a retired couple living mostly on Social Security who decides to withdraw a little extra from a retirement account to cover medical bills. In the past, that withdrawal might not have triggered immediate attention. Now, automated reporting often connects those transactions almost instantly. If the couple underestimates how the withdrawal affects their taxable income, they could face penalties later without ever realizing they made a mistake. This is why the new rule is being described by financial experts as a silent change. It does not always come with dramatic headlines. There is no alarm bell when it takes effect. Instead, it quietly reshapes the way retirement income flows through the tax system. Another reason this update matters is inflation. Over the last several years, everyday expenses have increased significantly. Housing costs, groceries, utilities, and healthcare have placed heavy pressure on fixed incomes. To cope, many seniors have found creative ways to supplement their finances. Some rent out a room, others sell items online, some pick up part-time work or freelance opportunities. These efforts can be helpful, but under the newer reporting environment, even modest earnings are less likely to go unnoticed. That does not mean retirees are doing anything wrong. It simply means that the margin for error has narrowed. Government analysts emphasize that the goal is transparency, not punishment. Still, mistakes can happen when people are unaware of the rules. And unfortunately, once an error enters the system, correcting it can take time and patience. The emotional toll of receiving an IRS letter should not be underestimated. Many seniors describe the experience as deeply stressful. Even if the issue is minor, the official language can feel intimidating. Some worry immediately about losing benefits. Others fear audits. In reality, most situations can be resolved, but prevention is always easier than correction. To understand why this rule is so important, it helps to look at how retirement finances have evolved. Years ago, retirees relied primarily on three pillars: Social Security, a pension, and personal savings. Today, the picture is more varied. Traditional pensions are less common. Retirement accounts like 401ks and IRAs play a larger role. Investment income, dividends, and required distributions all enter the equation. Each of these sources generates documentation, and the IRS now processes that information with advanced technology capable of spotting inconsistencies faster than ever before. Consider required minimum distributions, often called RMDs. Once you reach a certain age, you must withdraw a specific amount from certain retirement accounts each year. Failing to do so can result in significant penalties. The newer enforcement environment makes it harder for missed withdrawals to slip through unnoticed. Many retirees assume their financial institution will automatically handle everything. While banks and account custodians provide reminders, the responsibility ultimately belongs to the account holder. Overlooking a distribution is one of the most expensive mistakes a retiree can make, and the IRS has shown increasing focus on compliance in this area. Another factor driving the change is the federal government's effort to modernize its systems. Paper-based processes are gradually giving way to digital infrastructure. Electronic filing is now standard for millions of taxpayers, and direct deposit has become the preferred method for refunds and benefit payments. Modernization brings efficiency, but it also means data travels faster. When income is reported electronically, there is less delay between the moment money is received and the moment it is recorded. For seniors who value predictability, this shift can feel unsettling. Retirement is supposed to be a time of stability, yet financial rules continue to evolve. Financial counselors often advise retirees to think of tax awareness as part of overall retirement health, much like regular medical checkups. Staying informed does not require becoming a tax expert. It simply means recognizing that rules can change and taking the time to understand how those changes apply to your situation. There is also an important psychological aspect to consider. Many older Americans grew up during a time when government communication arrived primarily through the mail. Today, legitimate notices may appear electronically, and scammers sometimes imitate official messages. Because of the new reporting structure, criminals have found opportunities to exploit confusion. They send frightening emails or make urgent phone calls claiming that a tax problem must be resolved immediately. Seniors who have not heard about the new rules may be especially vulnerable to these tactics. Remember that real government agencies typically provide formal written communication and allow time for response. Panic is rarely necessary, and rushing into action can lead to further complications. Another area connected to the IRS update involves estimated taxes. Some retirees receive income that does not have taxes automatically withheld. In those cases, quarterly payments may be required. Missing them can result in penalties, even if the final tax bill is paid in full later. The challenge is that retirement income often fluctuates. A larger withdrawal one year, the sale of property, or unexpected investment gains can push someone into a different tax bracket temporarily. Without careful planning, that shift can produce an unpleasant surprise. Experts frequently describe retirement taxation as a puzzle in which every piece influences the others. Social Security interacts with investment income. Withdrawals affect taxability. Medicare premiums can even change based on reported earnings from prior years. When reporting becomes more precise, the puzzle demands greater attention. Despite these concerns, it is important to remember that knowledge is power. The purpose of explaining this update is not to alarm you, but to equip you. Millions of seniors successfully navigate tax season every year, and with the right awareness, you can too. Think of this moment as an opportunity to review your financial habits. Are important documents organized? Do you understand where your income comes from? Are withdrawals planned thoughtfully rather than taken impulsively? Small adjustments today can prevent major stress tomorrow. Many retirees find reassurance in working with trusted professionals, but even those who prepare their own returns benefit from staying informed. Reading notices carefully, keeping records, and filing on time remain some of the most effective ways to maintain peace of mind. Another encouraging point is that the IRS has expanded educational outreach in recent years. Officials understand that transitions can be confusing, particularly for older taxpayers who may not follow policy developments closely. Efforts are being made to clarify expectations and reduce misunderstandings. Still, awareness spreads slowly, which is why so many seniors remain in the dark about this rule. As we continue, we will look deeper into how reporting changes interact with benefit programs, why timing matters more than ever, and what financial behaviors could unintentionally trigger problems. Understanding these connections can help you move forward with confidence rather than uncertainty. Retirement should be about enjoying the life you worked so hard to build. Protecting that life includes staying ahead of financial changes, even when they arrive quietly. The new IRS rule is not something to fear, but it is absolutely something to respect. Ignoring it could lead to penalties, delayed refunds, or complicated corrections. Paying attention, on the other hand, helps ensure that your income remains secure and your benefits continue without interruption. Across the United States, financial advisors and retirement planners are noticing a pattern that is becoming impossible to ignore. Seniors are not intentionally breaking rules, yet many are discovering small reporting errors that quickly grow into larger problems. The new IRS enforcement approach is not necessarily harsher, but it is far more precise. That precision means discrepancies that once took years to surface can now appear within months, sometimes even sooner. One of the most common situations involves retirees who believe their financial life is simple because they are no longer earning a traditional paycheck. But retirement income rarely comes from just one place. A monthly Social Security payment may be combined with a pension, a retirement account withdrawal, investment dividends, or even occasional consulting work. When each of those pieces is reported separately and then matched electronically, accuracy becomes critical. What surprises many older Americans is how small changes can shift their tax picture. A single larger withdrawal to repair a roof, help a grandchild with tuition, or cover unexpected medical costs can push total income higher for that year. That increase may cause more of their Social Security benefits to become taxable. It could also influence Medicare premiums in the future because those premiums are tied to income history. The mistake is not taking the withdrawal. The mistake is failing to understand the ripple effect that follows. Experts often say retirement is no longer just about saving money, it is about managing how that money is distributed over time. The IRS update reinforces that idea. Timing matters more than many people realize. Taking funds too quickly or without considering the tax impact can create financial pressure later. Another area drawing attention involves digital payment platforms. In recent years, millions of Americans began using electronic services to send and receive money. Some seniors adopted these tools to make life easier, especially when helping family members or selling personal items. Others use them for small home-based businesses after retirement. The IRS has increased focus on how certain transactions are documented. While personal transfers generally remain separate from taxable income, payments connected to goods or services are often reported. Confusion happens when retirees assume that smaller amounts will not be noticed. Under modern reporting systems, documentation is far more thorough. Financial counselors stress that this is not about discouraging seniors from staying active or earning extra income. On the contrary, many retirees enjoy the independence that supplemental earnings provide. The message is simply that transparency protects you. Recording income properly prevents stressful corrections later. There is also a growing conversation about withholding. During working years, taxes typically come out of each paycheck automatically. In retirement, that structure can change. Some benefits allow voluntary withholding, while certain types of income do not. Without adjustments, retirees might reach tax season only to discover they owe more than expected. The emotional reaction to an unexpected tax bill can be intense, especially for someone living on a fixed budget. But the situation usually develops gradually, not overnight. It often begins with the assumption that everything is being handled somewhere in the background. The new IRS rule highlights an important truth. Retirement finances require periodic attention. Not constant worry, but thoughtful awareness. Another mistake professionals are seeing involves outdated contact information. As agencies modernize, communication increasingly depends on accurate records. If a notice is sent to an old address or linked to an inactive account, valuable response time can be lost. Something that could have been resolved quickly becomes more complicated simply because the message was missed. Organization plays a powerful role in preventing this kind of stress. Keeping tax forms together, saving benefit statements, and maintaining a clear record of withdrawals can transform tax preparation from a dreaded chore into a manageable annual routine. Many seniors who adopt this habit describe a sense of control returning to their financial lives. Instead of reacting to surprises, they feel prepared. Retirement should remain a chapter defined by dignity, independence, and security. Financial awareness supports all three. Today, you learned that reporting systems are faster, that income matching is more detailed, and that even small financial decisions can carry broader implications. You discovered that timing withdrawals matters, that supplemental earnings should be documented, and that preparation is the simplest path to peace of mind. Most importantly, you were reminded that knowledge protects the future you worked so hard to create. Carry this understanding with confidence. Let it guide your next financial review. Share it with someone who may not yet be aware. When seniors support one another with reliable information, entire communities grow stronger. The rules may change, but the goal remains the same: protecting your stability and ensuring that the resources you depend on continue to serve you well. Stay attentive, stay organized, and remember that informed decisions today help secure the comfort of tomorrow.